Hello and welcome to this investor camp coming in from Chennai. That's the capital of Tamil Nadu. Remember, Chennai has been known for its educational, its cultural, as well as its economic activities. And today, in fact, we are going to be focusing on our equity markets. Who would have thought just a couple of months back, people were calling for lower levels, but we have had a superb rally in the recent past. In fact, now we have rallied more than 500 points from those lows. And to help us analyze a whole host of data, we have Prakash Diwan.
Strategy for your budget. So this is beyond 1st of February. What do? All you have to do is identify the right mix of asset allocation that works best for your goals. You need to look at your asset allocation basis of age, your lifestyle, how much do you spend, can you save, you can't save, you're aggressive in spending, your risk-taking ability. Does a 500 points fall in the Sensex give you, straight away you need to go and take a sorbet rate or something. So that profile you need to do. Your earning profile, how long are you going to be earning? Is this your retirement money? Is it going to be, if it's lost, can you fill it up with something else? Do that. Take help of a financial planner if you have to. But that's the way to go about it. Having done that, you identify equity, debt and cash. Put only that much money into equity which can be invested for a long term. Because even if you're a trader, you start with a small trade, but then you become a long term investor because the target price didn't come, right? So keep money aside which is for the long term. Debt, only invest that money that helps you meet regular expenses because it generates regular income, whether it's bonds, FDs, whatever. Same way cash. Now after demonetization, I don't need to tell you this, but don't keep too much cash. Keep it in liquid funds, keep it in some sort of a short-term deposit, and only that much that you can pull out from an ATM, because that's what an emergency can help you do, right? If you have 1 lakh in cash, you can only pull out 10,000 now. So there's not much you can do with the rest of the 90,000. So don't keep so much money that you get stuck. So that's the broad idea. Now let's look at equity because that's what we are here for. What do you do when you look at equity? You focus on a couple of things. These three very important things, irrespective of budget, Brexit, GST, that you need to focus while building a portfolio is high quality businesses. So what do I mean by high quality? Look at management strength, competitive advantage. Look at an Eicher motor. They have an advantage. Nobody's been able to take that advantage away. Look at Asian Paints. Entry barriers are huge. Nobody can get in. Quality of management is great. Look at superior financials. So before you go to superior financials, first identify whether the business has a good pedigree, a good management backing it, a competent management. We start looking at financials saying there's a company available at just 3 PE multiple, I should buy it. But it is 3 PE because it deserves 3 PE. Not because it's a great company nobody's discovered, right? But it doesn't deserve. So superior financials comes much later. And there you could look at valuations, you could look at return ratios, what kind of return on capital is being generated. That's what Warren Buffett likes looking at. So we also look at it, all those kind of things. Leverage, how much is debt in the company's growth in running the business? If it's too indebted, there's too much of debt, you could have a JP Associates happening sometime. And of course, promising future. Everything is great, but does the industry have the strength to continue growing, letting the company grow, letting the company make that kind of money? So you need to identify that. And that's why it's very important to listen to people like Nigel when they talk about industries, sectors, listen to management when they come, what their plan is, how do they plan to go into this thing. So that is very important. So just focus on these three things in identifying stocks. And the most important thing, please don't build a portfolio of 100 stocks. More stocks doesn't mean more money. It means more money for your DP and for your broker. Don't build a portfolio which goes into, those hundreds. I keep on seeing a lot of mails come to me saying, sir, thoda help karo, please analyze this portfolio. I say, okay, happy to do it. And then I look at it, it's 190 stocks. Out of which, surprisingly, 90 stocks I've not even heard of, or they're delisted. So why have you kept that? Anyways, the value is so limited, let it be. Someday it will give something. And in that someday it will give something, he's applying for new IPOs, but not selling out all that kachra that is there. So that's how and precious capital gets locked in. Your attention gets diluted. So there's so many things that happen. Build a portfolio of 20, 21 stocks, whatever numerology suits you. Out of which, 50% of allocation in value terms should be large caps. This is generally the formula. I'm not saying it's a hardcore, hard and fast kind of a thing that you have to live by this, but this works very well. Because the way the market is, it gives you opportunities there as well. Large caps, you buy 50%, could be 5 stocks, good enough. Put 30% into mid caps, which is slightly smaller companies, but not very small. Buy about 6 stocks, works well. And the rest you put into small caps. And there you can diversify. Because small caps could upset things, right? So, if you bought only 3 small caps and put 30% of your money or 20% of your money, you could be at huge risk. So don't do that. I think this more or less kind of covers everything.
Well, that was the analysis coming in from Prakash Diwan, but we'll slip into a snappy break. We'll come back. We'll focus on more fundamentals as well as on the macros. Well, before we went into that short break, we had the word coming in from Prakash Diwan, but let's focus more on the fundamentals and let's hear what Mr. Dipen Mehta has to say.
So basically a secular growth story or a secular growth stock is a company which over several years, 5 years, 10 years, 15 years, 20 years, delivers typically anywhere from 15 to 25%, 30% type of year-on-year growth in profits. And the best examples in our markets is say Sun Pharma, where in 2000-2001 its net profit was 135 crores. And then over an 11-year period, the second column shows the growth in profits, 28%, 31%. It had an off year, 3% as well, but 28, 50, 35, 63. Again another off year in 2009-10 where profits declined by 25%. But basically over an 11-year period, its profits went up by 13.48 times and its stock price went up by 21 times in a matter of 11 years. That's what I call a secular growth story. Same with HDFC. Profits went up from 210 crores to 10,000 crores. And there in the second column you have the growth numbers. Can you see the consistency? 41, 30, 31, 30, 30, 31, 39, 41, 31, 33. Over a 14-year period, its profits have gone up by 48 times and its stock price has gone up by 22 times. If you just bought these 2 stocks in your life, I'm sure you could retire and live a very luxurious life. So these are the best examples of what we call a secular growth story, where profits consistently grow year on year, quarter after quarter, year on year, for 4 years, 5 years, 10 years, 15 years. And there are such opportunities in the market and we'll be talking more about that in future. We want a company which is running a marathon, which is doing 15 to 25% every single year. And to do that, what do you need? You need a vibrant industry for the company to operate in. It has to be large because the industry can grow only as fast as the industry. A company can grow only as fast as the industry. So typically the large industries are ones where there is mass consumption. Automobiles, banking services, healthcare, pharmaceuticals. And then you have to have a company over there which has the right business model, which has the right management dynamism, which knows how to manage the growth, which means that it won't take rash decisions, it won't expand beyond its capacity, it won't take too much debt on its balance sheet, nor do unrelated diversification. So there are some external factors which I've mentioned here and there are some internal factors also. So when you have a marriage of the external factors and the internal factors, what you have is a secular growth story, which effectively in our market parlance is what we call a multi-bagger, which is of course the dream of any stock picker. So let me get straight into it and identify which are the sectors we feel will generate the maximum secular growth stories from this point on. But these are the new winners. The new winners, the new secular growth stories, are you going to find them in the banking sector, especially the private sector banks. Next are the NBFCs. The portions of the banking industry which cannot be covered by the banks is being taken up by the NBFCs. What is their basic USP? They have managed the collection part. See, banking, NBFC business is easy to grow the loan book. It's easy to convince someone to take the loan. The problem is collection. which is where companies like Bajaj Finance or LIC or Bharat Financial Inclusion, Manappuram, Muthoot Finance, Cholamandalam, Shriram Transport, Shriram City Union, they have mastered the art of doing this collection. Next are the consumer-oriented stocks. Now, one observation which I like to make to you is that the consumption pattern in India is changing. 5 years, 10 years, maybe not 10 years, 15 years ago, 20 years ago, we were consuming what? General FMCG products, toothpaste, soaps, washing powder. But what are we consuming more just now? We want beautiful houses, we want transportation, we want to, have better healthcare facilities, we want more and more appliances in our houses. So the actual spending share is shifting away from the toothpaste, the cigarettes, the washing powder, the shampoos to products where we are moving up the value chain, we are improving our entire living standards. So now, even after you have found a secular growth story, like many people have invested, say, in a HDFC Bank or a Sun Pharma, or could have invested in a Bajaj Finance or Aisha Motors, what I realize is they sell it off. The stock price goes up double, triple. They bought it at 100, it's at 300. Let's get out. They want to book the profits. Some have price targets. Anything stock goes up by 15, 20%, 30%, I sell. That's a mistake. If you have a rock solid story, don't sell it, because it will continuously grow year after year, year after year. It's not going to be a secular straight line, but over a 2-year, 3-year, 4-year, 5-year period, it will become a multi-bagger. So don't trade in it.
Well, we heard some good fundamental analysis coming in from both Dipan as well as from Prakash. But let's shift focus to the macros and let's hear out what Yuvika Oberoi, economist of Yes Bank, has for us.
Heading into 2017, global agencies such as the IMF have pegged global growth to improve in 2017 from a level of about 3.1% last year to about 3.4%. Not a great improvement, but nevertheless, it's in the right direction. The key here will be the economic recovery of the US economy, which we have seen steadily grow in the last 1 year, which was also validated by the US Federal Reserve, which did hike its Fed funds target rate by 25 basis points at the end of the year. What will be critical going forward is that most of the macroeconomic projections of the US economy look very uncertain at this point in time. And I'm sure this you understand because there is a new administration at helm in the US, and most of the policies that are expected, whether on the fiscal front or otherwise related to trade, remain something in an uncharted territory. So even we don't know where, how much the impact of the fiscal policies that Trump will announce will eventually impact not just the US, but also its global trade partners. But for now, I think we can take comfort from the fact that 2017 has begun on an optimistic note for equity markets globally, including India, where, our equity performance has been better than most of our peers. So let me get to the question of why Indian equities. So in a global economic backdrop where growth is expected to only do slightly better in 2017, investors globally will look for pockets of growth. India remains the fastest growing economy in the world. And this, we believe, is ample proof of the fact that India will offer a stable investment destination and will, be a lucrative investment destination for foreign investors. The structural growth story of India continues to remain intact. In fact, we expect the growth premium of India to improve further in 2017. So when I say the growth premium, it is nothing but a difference or a markup at the rate at which India is growing vis-a-vis the rest of the world. And this difference we expect to improve from about 3% in 2016 to 4% in 2017. In addition, most of our macros, whether growth, inflation, current account deficit, fiscal deficit, even the FX reserves have seen a structural turnaround in the last 2 to 3 years. So this is largely from a long-term perspective that India continues to remain, a growth story. But what about the next, say, 6 to 9 months? What are the key themes that are expected to play out in the economy, which would have a positive bearing on the equity market sentiment as well? Demonetization, a lot has been said and written over the last 3 months. I'm sure a lot of you have your own personal experiences affecting your business, consumption cycle as well. But I would like to highlight 2 points here from an economist's perspective. The first is that the initial set of data for the periods of November and December, which we track very closely, are now coming in. And we create this heat map to see whether the momentum in the economy has slowed, whether it has improved. And our basic analysis so far indicates that it's the manufacturing sector which has taken a greater brunt out of as a result of the demonetization, whereas services as a sector has performed relatively better in comparison to manufacturing. A lot of services, if you'll see, like sea cargo, tourism, have been more resilient after the demonetization. Having said so, we do understand that, demonetization will have a negative impact, a short-term disruption on economic growth. And as a result of this, we have downgraded our GDP forecast for FY17 by about 90 basis points from 7.6% that we had pegged earlier to about 6.7% now. But the question here remains, which I'm sure is on everybody's mind, that how quickly can we expect the economy to get back on track? Our back-of-the-envelope calculations suggest that the impact of demonetization will be short-term, somewhere around 6 to 8 months. And thereafter, as we enter the new fiscal year, probably by the end of the first quarter of next financial year, we should expect the economy to come back on track. GST, as we are all aware, the deadline for implementation has been pushed forward by a couple of months. So somewhere around the month of July, we should see GST coming on board. The key here will be the allocation of GST rates across different goods and services, which will have important sectoral implications. So look out for sectors where tax incidence could probably decline a little. Those are the sectors where there will be positive spin-offs after the GST. In addition, not just the short-term perspective, but even longer-term perspective from GST, as it will accelerate the movement away from the unorganized sector to organized sector. Look out for certain, sectors where GST will facilitate the move from unorganized to organized sector. That could also offer growth stories.
Well, on that note then, we'll slip into a short break. You come back, we'll get to the fun part, the Q&A session. Stay with us. Welcome back to the Investor Camp coming in from Chennai. Now, we're not just on television sets, we're also on social media. And if you want to be part of that, then you can download that Investor Camp app. You can get it from our Google Play Store and in fact track all the investor camps that are taking place all across the country. But as promised, let's move on and let's get straight to our Q&A session. Our guests are waiting by.
This is a question for Mr. Dipen Mehta. So you have suggested to buy this Eicher Motors. Is it worthwhile to buy at this rate?
I mean, you do the calculation yourself that here's a company which is growing at 25-30%. They're not able to meet the demand also which is there. They are increasing the capacity. And that's just in India. And they haven't even explored the global market. And the brand pull is so strong. I mean, it's amazing. In my 30 years of investing, I've never seen such strong brand pull. I mean, it's like, you have to have this bike. I'll give you a small incident. I was on the Ultratech Semco con call. Ultratech Semco con call. The CEO over there was asked this question that, this pay commission has given more money in the hands of the government employees. So do you think it will increase the demand for cement, considering that a lot of the government employees are in the rural areas? So this is what he said, and you can go, the recording is there, that once money comes in the pocket of the average consumer, the first thing he does in rural areas, he goes and buys, or he goes and repairs his house, or he'll make from kacha to pakka. And second thing he wants to do is buy a bullet.
Oh, wow.
This is not me, not you, someone from a different industry giving his perspective of what the average consumer wants. When you have these kind of dynamics, then where's the question about it? Of course, things can go wrong. There are risk factors involved. Equities investing is all about risk factors. Okay? But these are the kind of growth parameters we are dealing with.
My question is related to pharma sector.
Okay.
See, after the US government's new president, what is your view about the pharma sector? Especially, I am wondering that whenever US FDA approves some tablets, pharma shares going up by 5% or 7%.
So you want to know which stocks to buy in pharma
like
industry at current levels. Deepa, you spoke about a few pharma stocks.
Yeah, I think with usual disclosure that we and our clients are invested, we like companies like Natco Pharma, Strides Arcolab, Aurobindo, Glenmark. I think these are the 4 companies which come to mind, which look quite interesting.
Prakash, you, pharma?
If the worry is about what's going to happen with the new presidency, in place, I think there's a lot of hype that's around that whole sector. So we will see some stress for the next couple of months, maybe till Obamacare gets repealed and some solution happens. But if they're looking at reducing costs, let me tell you, Indian pharma companies will benefit because they are one of the lowest cost producers of generics in the world. The fight the US government has is with the multinational giants, not with Indian companies as yet. And as Dipin explained in his presentation, China is more into API. So, that's a separate area. It's more of a raw material area and not end product. So I don't think Indian pharma companies will be so badly off after all this. All these names you could look at, all of them have a very good strength pipeline. You could look at Biocon also, it's one of my favorites. You continue to do well even beyond where it is.
Well, on that note, we'll wrap up on this edition of Investor Camp coming in from Chennai. But we'll be back very soon with the new city. Thanks so much for watching.